So Adyen reported this week. Actually, this was a good report. In sort of contrast to the Airbnb report, I was impressed with this one. It's pretty much what we've come to expect from Adyen. It's just sometimes the market sends it down 20% on this report, and I sit here scratching my head on the show. And then sometimes it sends it up 15%, and I sit here scratching my head on the show. This is almost exactly what they told you was going to do, was what they did. So net revenue, which is essentially, because they don't report revenue in the way that standard companies do, because they take the full transaction value as revenue, which isn't really revenue. They strip it down to this net revenue mark, which gives you an idea of the actual cash that comes into the business rather than the payments that flow through it. So hope that makes sense. But net revenue was 1.082 billion. That was up 22% year on year. Process volume was, and sorry, this is for the half too, so the second half of the year. Process volume was 666.4 billion. That was also up 22% year on year. Actually up 28% if you exclude a single large volume customer that came over. So of these volumes, total point of sale volume, so these are physical purchases, were 137.1 billion, up 48% year on year. So they generated about 569.2 million euros of EBITDA. That's up about 35% year on year. EBITDA margin landing at about 53%, so strong. Free cash flow conversion ratio was 88%, and CapEx came in at 5% of net revenue. So they're all their targets that they usually set, and they met them all. In terms of full year, net revenue came in at 1.996 billion, up 23% year on year. Process volume was 1.285.9 billion, up 33% year on year. Again, 27% excluding a single large volume customer. PayPal, just for comparison, is doing 1.6 trillion in TPV, and that's only growing at 7%. So Adyen is like hot on their heels, growing at what's that, nearly five and a half times the speed. Five times the speed of PayPal. So of these volumes, point of sale volumes were 232.7 billion euros, up 46% for the year. EBITDA of just under $1 billion, up 34% year on year, with an EBITDA margin of 50% for the full year compared to 46% last year. So becoming more efficient as well. Free cash flow conversion for the year ended up at 87%, CapEx 5% of net revenue compared to 4% of the year before. Ethan Tandowski, the CFO, he said, "We are proud to have delivered a strong year of growth, further cementing our position as the trusted partner of choice for global businesses. Once again, expanding our relationships with existing customers was the key driver of our growth, reinforcing the vast opportunity that remains. Strengthening these partnerships contributed to net revenue growth, reaching 22% for H2 and 23% for the full year, a true testament to the significant value we continue to provide. As we continue to build Adyen for the long term, we are pleased with our performance in 2024, remain confident about delivering on our financial objectives in the year ahead." And just to reiterate, I've pulled those financial objectives for you. Essentially, it's not seen any developments in its business over H2 2024 that's makes them need to change this. So the objectives are essentially to grow net revenue annually between the low 20s and the high 20s% up to and including 2026, to improve EBITDA margins to levels above 50% in 2026, which they're obviously already done, and to maintain a sustainable CapEx level of up to 5% of net revenue, which is what they're at the moment, Steve. So doing really well, and the market rewarded them for doing so. Not long now until they take over PayPal, Steve. I think PayPal shareholders, if they're not worried about it, I would ask why.
They might be worried about that. I think in a lot of cases it's because they haven't heard of Adyen or haven't paid proper attention to Adyen, but that's not a good reason to not be. Well, I mean, it is and it isn't a good reason to be not be worried about something. But just guiding for sort of fairly casually guiding for revenue growth somewhere above 20% then for the next couple of years. Very, very cash generative business, isn't it? I was looking at some of their you talked about their CapEx creeping up from 4% to 5%, I think, which On the one hand, that doesn't sound like a lot. On the other hand, it's 25% more of your revenues. Not 25% more of your revenue. Sorry, 25% growth in your capex when you go from 4 to 5. But this really isn't a particularly capex heavy business by kind of any means. It's just growing very, very well, and it's got something in the region of high 80s to 90s, fairly steadily cash conversion, which is not a huge surprise from this, but yeah, very impressive as operations go. I don't think I heard, Steve, I might have missed it, but did I miss stuff about take rate on this? I mean, we talked about Wise a few weeks ago on the subject of take rate, and Wise had deliberately been bringing theirs down effectively to widen their moat, or at least that was our kind of hypothesis around here. Market didn't like that very much from Wise. I think they saw it more as a sign of weakness than as a sign of long-term strength, and maybe that's true, but I didn't see it that way when I thought about it. Did you know anything about Adyen's take rate for this half?
It's the same deal as everything, so it's volume-based discount. So the more volume you bring on, the cheaper the rates go for Adyen. So you come in at a set rate, and the more and more you bring. They have actually been hiding the average, or not reporting the average take rate in the shareholder letter, where the vast majority of this information comes from. So you could get an average, but I don't suppose the average would give you much to go on, especially when there's, as you can see from these numbers, there is somebody who's brought a hell of a lot of volumes to Adyen, who would be obviously just skewing that figure somewhat. It's probably one of those ones where the mean is not your best thing, and they don't report the median. So I guess the other thing we should point out, Steve, as well, which not noted in this but noted in previous episodes, is stock-based compensation at Adyen is pretty much non-existent. They don't really give away. They choose to pay the staff better rather than give them parts of the company, which is entirely their choice. But if you after a fast-growing payment processor, that is, it's strange really, because you would say that it's sort of positioned towards shareholders, but not really, because the employees are well looked after as well. So I think they've kind of got the best of both worlds there. I think it's really attractive, Steve. I'm not sure I'd be in a rush to buy it right here, but if they can continue this 20% growth, for a few years on, it's one of those stocks that gets cheap quick, Steve.
It's a hard one, isn't it? We report on this pretty much every time they launch some sort of update or earnings, which is, I feel like we talk about them nearly quarterly, but they have reports for the half, certainly, that are more detailed. And it feels to me like I also would struggle to buy it right now. There's a big earnings multiple, but you probably don't really care if you think revenues are going to grow at 20% for the next couple of years or so, and you can think, well, after that it will grow at some rate and we'll be pretty close. But I feel like the biggest psychological obstacle I have to buying this is a difficult one, which is the two things. One is it's gone up quite a bit as a result, and that's kind of natural, and I'm not super critical of people when they think that way, even though I and they know it's the wrong way to think about these things. See various charts of things that go up. But Adyen has mostly been a chart that's gone up, but it feels like if you just looked at the kind of stock price movements here, you do tend to get dips to buy. As you said at the start in your kind of opening thing, it may well do the same thing again in 6 months' time and then lose 20%. And then you'll feel like, well, actually, that was, in the case of Adyen, you would think, actually, that isn't wildly unusual or unsurprising. There are some companies that sort of never, Costco or something, right, where you wouldn't pay attention to the fact the stock is at a high particularly. You'd pay attention to the business, and you could say from there, well, okay, I think it's still a goer. I disagree, but I could see someone thinking that. And it just never seems to drop back to the sort of valuation that I look for it at. Over the long term, could this work? Yes. Adyen, that argument doesn't really work with me, because this is a stock that goes... it sort of trundles along until in a diagonal until an earnings report, and then goes vertically one way or another. And I'm not sure I could tell you with much confidence which way the next one will go.
No, and it's strange really, because it says to the market, we're going to grow at 20%, and has said that, we're since 2021, we're going to grow at 20% between the low 20s and the high 20s. And then the market gave it a massive premium and sent it up to 2,700 euros, which obviously Adyen can't do anything about. It fell 50% to go down into 2022 to get to a more reasonable after reporting growing at 20%. And then increased again from there, Steve, up another sort of 20% between September and August, where it reported growing at 20% and fell another 50%. So it's just been really, really strange. I mean, back in October, it was €640, and it put a report out saying we've done 20% growth, and the market sent it up to 1,200. So it is really a strange stock to predict. It's the market, it feels strongly about it sometimes and really negatively about it other times. But I've been holding this one since about 2021, so it never really seems to go anywhere near my average, apart from that fall in 2023. And when it did, I snapped up quite a large handful of extra shares. So it's actually become my second biggest position now. It's closing in rapidly on Amazon after today's performance. It's only about £1,000 difference, and the way this moves, it could catch up rather quickly.
You've been watching a segment from the Playing FTSE show, brought to you in association with our favourite broker, Trading 212. For the full version of the show, check us out on Spotify, Apple, or wherever you get your podcasts. And if you open a new account with Trading 212 using the link in the description, there's a free fractional share in it for you. Just make sure that you use the code FTSE when you sign up. Terms and conditions apply, and do remember that when investing, your capital is at risk.